bought in Dubai in 2022, you probably feel like a genius. Prices surged, records shattered, and every week another tower sold out off-plan. But zoom out. A wall of new supply is coming. Analysts are flashing correction warnings, and the question for 2025 is simple. Are we at the peak or just at halftime? Today, I'll show you what's really driving the boom, why some experts now expect double-digit price falls, and a clear, step-by-step framework to decide whether you should buy now, wait, or walk away. Stay to the end for a checklist that can save you tens of thousands of dirhams in fees and mistakes. Since early 2022, Dubai home prices climbed hard. Safe haven money flowed in, visas got easier, and the city doubled down on what it does best: speed, scale, and lifestyle. The narrative matters too. The long-term plan to expand the economy and elevate Dubai among top financial hubs pulled buyers from everywhere. The result was simple: more demand than supply in the right areas. Transaction volumes hit records. Confidence fed on itself. So yes, the boom was real, but booms don't answer the most important question: what's next? Major ratings agencies and banks now talk openly about a moderate correction, not a crisis, a correction. Why? Supply. Developers are slated to hand over a very large number of units in 2025 and 2026, roughly double the pace of the prior 3 years. When that many keys hit the market in a short window, sellers lose pricing power, especially in buildings where units are near identical and buyers can play one landlord against another. At the same time, system risk looks contained. Banks are better capitalized, loan exposures are lower, and the big developers have buffers. That's why the base case is a soft landing, or a patchy correction, not a 2009 repeat. Still, if you buy the wrong product at the wrong time, corrections hurt. Your why. Are you an end user or an investor? End users value life stability over nickels and dimes on timing. If you'll live there 5 years or more, the monthly cost fits comfortably, and the home makes your life easier. You can buy into a correction and still win. Investors care about net yield, exit depth, and risk controls. If you're investing, numbers aren't a suggestion, they are the deal. Your what? Not all properties move together. Think in 3 buckets. Bucket 1, prime and scarce. Waterfront plots, genuine parkfront, iconic views, and branded residences with real global pull. These fall less and recover faster because wealthy global demand competes for them regardless of short-term noise. Bucket 2, A-grade well-managed communities, efficient layouts, realistic service charges, and proven leasing demand. Not flashy, but liquid. Bucket 3, commodity stock. Dozens of similar units, thin resale demand, high service fees, or weak management. In a correction, this bucket gets hit hardest because buyers have options. Your when. Watch handover waves. Prices often soften around handover when investors try to flip before final balances and the first year of service charges. If you're patient on the secondary market, 45 to 90 days on market plus 2 price reductions is a classic setup for negotiation leverage. Your how. In Dubai, transaction costs are meaningful. Budget them early. The standard transfer fee is 4% to the land department. Add trustee and registration fees. If you use an agent, many secondary deals include a 2% commission. If you take a mortgage, expect a bank fee, a valuation, and the usual paperwork friction. And don't forget service charges. A stunning lobby is great until you're the one paying to keep it stunning. Ask for 3 years of service charge schedules and compare the dirhams per square foot rate to neighbor buildings. The quiet killer of yield is a fee line that creeps up every year. There are 3 different paths to take as a buyer in Dubai. Path A, the end user. You have a stable job, kids starting school, and you hate moving. If the monthly payment fits your budget with a sensible rate buffer and the home ticks your life boxes, commute, schools, community, buying now can still make sense even if headline prices slip 5 to 15% in the next year. Your reward is 5 years of living value you can't price in a spreadsheet. Focus on livability and resale depth. Metro-adjacent towers with efficient layouts, townhouses in mature communities with actual trees and schools, and villas in neighborhoods with real social infrastructure rather than just a glossy rendering. Path B, the yield investor. You want income that survives a wobble. Your 2 enemies are yield compression and operating friction. If prices outran rents, gross yields thin, and fees, vacancy, and furnishing capex for short lets erode what's left. Fight back by hunting mispriced secondary units, from motivated sellers, especially listings that have sat more than 60 days. Target rental magnets, walkable to the beach or metro, next to major employers, or inside communities with school, clinic, and retail on foot. Model net yield, not gross. Gross can say 8%. Net after transfer fees, service charges, and realistic vacancy might be 5 to 6. Buy the net number. Path C, the off-plan flipper. You lock 10 or 20% now and plan to sell the paper before handover. Be honest. In a supply-heavy year, who is your buyer and why will they pay more than you did? If you can't answer that in one sentence, unique view stack, limited tier, and a delivery window where competitors will be late, you buy a 2 million dirham apartment on the secondary market. Your transfer fee at 4% is 80,000 dirhams. Add trustee and registration, several thousand more. If there's a 2% agency commission, that's another 40,000 dirhams. If you finance, add the bank fee and evaluation. Before you move in, you're already beyond 125,000 dirhams in costs. Now, layer in service charges. On a 1,100 square foot unit at 20 dirhams per square foot per year, that's 22,000 dirhams annually. The headline price is not the total cost. Smart buyers negotiate from the net number, not the brochure number. First, supply. The sheer number of units slated for delivery over 2025 and 2026 is the biggest single driver of pricing pressure. If those handovers cluster in a few submarkets, expect listing pressure there first. Second, demand mix. Dubai's buyer pool is global. European rate cycles, currency moves, South Asian high net worth migration, corporate expansions, and expat job creation all shape absorption. Even if prices soften, strong transaction volumes suggest a soft landing rather than a crash. It's not just the price trend, it's also how quickly deals still close. Third, policy and tax. Individuals continue to pay no personal income tax, which supports net of tax yields. Corporate buyers now face a 9% corporate tax above a small profit threshold, and very large multinationals fall under a 15% minimum top-up framework. None of that breaks the case for Dubai. It just nudges the calculus and adds the need for proper structuring and good advice. Fourth, rents versus salaries. If wages don't keep up with rent inflation, rent growth cools. If your thesis requires fast rent hikes to make your numbers work, pressure test the rent line. Ask for proof of recent leases in the same stack and the same view tier, not just the same building. Use a triage method. Prime and scarce assets are protected by moats, beach adjacency, marina frontage, true park front, and iconic views. Scarcity equals resilience. A-grade, mature communities are protected by livability, human-scale planning, actual sidewalks and shade, grocery and daycare within 5 minutes, and stable service charge histories. Commodity and over-marketed stock has no moat. Many near-identical units, high fees, weak management, and investor-heavy ownership that races to the bottom on rent. In a correction, that's where pain concentrates first. Add one more filter, resale depth. Pull a 90-day snapshot of the submarket. How many similar listings are live? What's the average days on market? How many price reductions per listing? Shallow pools mean fragile pricing. On the secondary market, use time on market to your advantage. If a listing has sat more than 60 days and been reduced twice, anchor your offer with all-in math. Say, at this price, after transfer fees and service charges, my net yield is 5.8%. I will transact this week at this number. Ask for furniture and appliances to reduce setup costs for rentals. Insist on a third-party snagging inspection and a punch list with deadlines. For off-plan, prefer escrow-protected projects with visible on-site progress. Push for payment plan flexibility that shifts more to post-handover if you intend to rent. Get rental comparables from the same broker's lettings team and ask them to commit to a realistic range in writing. If they won't, that's a red flag. Paperwork matters. Read the sales and purchase agreement. Check handover timelines, penalty clauses for delays, and whether service charges are estimated or fixed initially. Small print makes big money. Scenario A, soft landing. Some handovers slip, easing the supply wave. Prime and A-grade communities maintain leasing velocity. Prices dip mid-single digits to low teens, then flatten as demand absorbs stock. Transaction volumes remain healthy. Confidence stabilizes. Scenario B, patchy correction. Deliveries cluster in a few submarkets. Off-plan flips hit bids. Commodity towers cut asking prices to clear inventory. We see declines in the mid-teens in those pockets. Prime holds better. Villas with real scarcity barely blink. Financing stays available. Systemic risk remains low. In both paths, selectivity wins. If you buy quality, manage fees, and respect cash flow, you sleep at night. So should you buy in 2025? Buy now if you're an end user with a 5 to 7 year horizon and the home fits your life. Buy selectively if you're an investor. Hunt mispricing in the secondary market, prioritize genuine scarcity, and stick to A-grade communities with stable service charges and deep rental demand. Wait if your thesis is to flip before handover without a crystal clear exit. In a supply year, you want optionality, not hope. Dubai remains one of the world's most compelling real estate stories. But in 2025, the edge goes to buyers who can say no to 9 out of 10 deals and yes to the one with a real moat and real math. Was this useful? Tell me in the comments if you're seeing price cuts in your building or if sellers are still holding firm. If you want my due diligence checklist and a net yield calculator, hit subscribe. In the next video, we'll break down service charges by community and show you how to spot the ones that quietly kill returns. I'm your host. Thanks for watching, and buy smart.